Every company must file their financial statements with the Register of Companies. But are they of any use to you? Of course they are. Analyzing a company's financial statements helps you understand the growth of a company and its ability to pay back its debt. But how do you analyze the financial statements? Watch this video until the end to know the answer. Hello and welcome. I am Maishri from Clear. We have assisted more than 4 lakh growing businesses. Do subscribe to support us and get a clear explanation of business concepts. The analysis of financial statements helps various stakeholders involved with a company. Let's look at how the financial statements of a company helps its stakeholders. Management of a company. The company's finance department does an ongoing analysis of the company's financial statements, particularly operational metrics such as the profit by product, cost per distribution channel, cost per delivery, etc. that aren't seen by external entities. Investors. The current as well as prospective investors scrutinize the health of the company by performing an analysis of the financial statements. It helps them to understand the company's ability to continue as a going concern, generate cash flows, and ensure that the company continues to grow at least at the historical rate. Creditors. A creditor or anyone who has provided funds to the company will be interested to know the ability of the company to pay back the debt and their several cash management measures which they can get an idea from analyzing the financial statements. Regulatory authorities. In case of public companies, the Securities and Exchange Board of India, that is SEBI, examines their financial statements to see if they conform to accounting standards, SEBI rules and guidelines. Moving on to the most awaited part of the section. Each method of analyzing financial statements gives visibility of variances, business trends, and also flags various issues. There are various methods and techniques to perform financial statement analysis. However, here are the most common methods of financial statement analysis. First, horizontal analysis. Horizontal analysis is a two-year comparison of analysis of the financial statements and their elements. It is also referred to as trend analysis, usually expressed in monetary terms and percentages. This comparison provides analysts with insight into the aspect that could contribute significantly to the financial position or profitability of the company. Second, vertical analysis. Vertical analysis is a financial statement analysis technique in which every line item of the financial statement is listed as percentages based on a figure within the financial statement. The line items on income statement could be stated as percentages of the gross sales, while the line items on the balance sheet could be stated as percentages of the total assets or liabilities. And in the case of cash flow statement, every inflow or outflow of cash could be stated as a percentage of total cash inflows. This analysis would create insight into the changes in the allocation and distribution of total assets. Third, ratio analysis. A ratio between two quantities is used to represent the relationships between different figures on the profit and loss account, balance sheet, cash flow statement, or other accounting records. It is a form of financial statement analysis used to quickly indicate the company's financial performance in various key areas. Ratio analysis as a financial analysis tool possesses many important features. Additionally, ratios could be used in the form of trend analysis for identifying the areas within a company where performance has deteriorated or improved over time. Some of the key ratios include profitability ratios. Profitability ratios measures the results of a company's overall or day-to-day management performance and efficiency. Common profitability ratios include gross profit, net profit, return on equity capital, return on capital employed, operating ratio, earnings per share and dividend yield. Liquidity ratios. Liquidity ratios measures the current solvency of a company's financial position. These are calculated to ascertain whether a company can meet all of its existing business obligations. The most commonly used liquidity ratios are the current ratio and quick ratio. Solvency ratios. Solvency ratios evaluate the company's ability to meet its long-term interest expenses and also repayment obligations. The most common solvency ratios are the equity, debt to equity and interest coverage ratios. Activity ratios. Activity ratios indicate the quality of management as they reveal how well the management utilizes the company's resources. Some of the key activity ratios include the accounts payable turnover ratio, accounts receivable turnover ratio, fixed asset turnover ratio, inventory turnover ratio, and working capital turnover ratio. However, please take note that you are using financial statements from more than one reporting period, and each of the financial statements should be in a similar format so that you can have all the relevant data in a comparable format to understand one period to another. Let us know in the comments below if you understood the methods of analyzing the financial statements. If yes, please write clear in the comments below. If not, let us know your query in the comments below and we will address them as soon as possible. Investigating the business, finding logical explanations for the variances, and performing changes based on positive or negative trends are the ultimate goals of the financial statement analysis. So folks, that's it for today. You can contact our experts for business or finance related queries by clicking on the chat link provided in the description box below. Also, don't forget to subscribe to our channel for more such informative videos and stay tuned for more updates.